Why gold tells us this crisis is all about the dollar. A period of risk aversion should help the metal, but the dollar is too strong. When attempting to cure contagion, it is necessary to tell the difference between symptoms and causes. And it looks as though Turkey's financial crisis is only a very severe symptom of the contagion that is moving through emerging market currencies. The underlying cause appears to be the strong US dollar. The Turkish lira fell again on Monday, but more striking was the uniformity of the falls in other emerging markets against the dollar. JP Morgan's index of emerging market currencies fell to a fresh record low since its inception in 2010, falling 1.6% by noon in New York. India's rupee, one of the strongest emerging currencies in the years since its sharp sell-off during the 2013 taper tantrum, dropped to a record low against the dollar. Indonesia's rupiah suffered the same fate. South Africa's rand, currency of the country most obviously dependent on dollars for financing after Argentina and Turkey, the two countries to have suffered currency crashes this year, is also now under severe pressure. But the clearest tell that we should be focusing on the strength of the dollar, rather than on events in Turkey, comes from gold. Demand for gold may ultimately lie in the eye of the perceiver, but the gold price is a great gauge of perceptions of risk, and of fears that paper currencies may suffer debasement. It remains an important link in the financial system. And somehow the gold price has tumbled 12% or when measured in dollars, since its recent peak 12 months ago, following a trajectory that looks remarkably like that of an emerging market currency in that time. It has given up all its gains since the election of Donald Trump in November 2016. As we are in a risk-off environment, when investors try to limit their risks, gold might normally be expected to be exactly the kind of place where they would seek shelter. Why not this time? In part, the demand for gold tends to come from emerging markets, whether from individuals for jewelry or from central banks for their reserves, and so this is a sign that investors in emerging markets now feel it necessary to buy dollars rather than gold. And in part, gold tends to function as an indicator of alarm about the Federal Reserve. If investors think that the central bank will be too easy and allow inflation to take off, as was widely if inaccurately believed during the years of gold's bull market immediately after the crisis, they will buy gold. At present, the perceived risk is that the Fed will be too hawkish, and thus strengthen the dollar. Turkey may be able to regain international confidence, or it may not. But even if it can halt its own crisis, that will not halt the contagion, which stems from the strong dollar, and the re-evaluation of emerging assets that it has forced on investors. US dollar becoming unreliable for international trade. The issue of looking for an alternative medium for financial transactions that can decrease the domination of the dollar in international trade has been a hot topic recently, particularly after the reimposition of US sanctions on Iran and Russia, leading to the rise of critical voices against the greenback and concrete solutions to increase the share of other currencies in trade and financial markets. Exposed to US sanctions, Turkey and Russia have also recently expedited their efforts to increase the utilization of local currencies in trade transactions. In a speech on Saturday, President Recep Tayyip Erdogan said Turkey is preparing to trade with its top trade partners like China, Russia, Iran, and Ukraine in local currencies instead of the US dollar, adding that it was also ready to do the same with European countries. President Erdogan's effort have garnered support from Moscow, as the Kremlin spokesperson said yesterday. Moscow aims to use national currencies in trade with Turkey, instead of dollars or euros. The question of using national currencies in bilateral trade has been discussed many times in talks between Russia and Turkey, Dmitry Peskov told journalists via conference call from Moscow. The use of national currencies in mutual trade transactions is a topic that has been raised by the Russian side at various levels, including at the highest levels, for a long time, he said. President Putin has repeatedly spoken of such a possibility and, moreover, of such expediency. Of course, this is subject to scrupulous study, scrupulous calculations, but this is what we seek in our bilateral trade and economic relations, and what has been repeatedly discussed at bilateral Russian-Turkish talks, he added. According to the latest Treasury International Capital Report, Russia had liquidated virtually all of its U.S. Treasury holdings, selling off the bulk of its U.S. government bonds in just 2 months, March and April. In an interview for the Russia One TV channel, Russian Finance Minister Anton Siluanov said, Russia aims to keep reducing its investments in American securities following new U.S. sanctions. He added that the U.S. dollar is becoming an unreliable tool for payments in international trade. The minister also hinted at the possibility of using national currencies instead of the dollar in oil trade. I do not rule it out. We have significantly reduced our investment in U.S. assets. In fact, the dollar, which is considered to be the international currency, becomes a risky tool for payments, Siluanov noted. As Russia is contemplating abandoning the dollar, the recently introduced Chinese Petro-Yuan oil futures contract has soared. The Chinese oil futures contract spiked to a new record high last week, when the U.S. reinstated sanctions on Iran. This was the biggest daily move in China's oil futures since the contract's inception in March to an all-time high. In April, Turkey and Iran issued the first letter of credit in the form of a national currency swap to exchange the Iranian rial and Turkish lira. The swap will ease trade, transactions between the two countries and lower foreign currency risks after both currencies faced depreciation recently. Under this system, there is no need to rely on a third-party currency, like the US dollar or euro, the news agency said, quoting Iran's central bank. Russia's finance minister, we may abandon dollar in oil trade as the dollar is becoming too risky. 1 month ago, the bond market and political pundits did a double take when, according to the latest Treasury International Capital Report, Russia had liquidated virtually all of its U.S. Treasury holdings, selling off the bulk of its U.S. government bonds in just 2 months, March and April. And with the U.S. threatening to impose a new set of crushing sanctions on Russia, including in retaliation for the alleged Novichok nerve gas attack in the UK, Russia not only intends to continue liquidating its U.S. holdings, but to significantly reduce its reliance on the U.S. dollar. Speaking in an interview for the Russia One TV channel, Finance Minister Anton Siluanov said that Russia aims to keep reducing its investments in American securities following new U.S. sanctions and said that the U.S. dollar is becoming an unreliable tool for payments in international trade. The minister also hinted at the possibility of using national currencies instead of the dollar in oil trade. I do not rule it out. We have significantly reduced our investment in U.S. assets. In fact, the dollar, which is considered to be the international currency, becomes a risky tool for payments, Siluanov noted. On Friday, the Russian ruble sank to the lowest level in over 2 years after news about new U.S. sanctions against Russia over the alleged poisoning of former Russian intelligence officer Sergei Skripal and his daughter Yulia in Salisbury, UK, coupled with general selling of emerging market currencies as a result of the growing Turkish financial crisis. According to media reports, the first package will imply a complete ban on the export of electronic devices and dual-use components to Russia, whilst the second package may include a decrease in diplomatic relations, a ban on flights of Russia's Aeroflot carrier to the United States and an almost complete suspension of U.S. exports. Siluanov said the sanctions are unpleasant, but nothing fatal. In response, Moscow will only continue to minimize investment in the U.S. economy and securities and will push for payments in rubles and other currencies, including the euro. The response, however, will not target American companies operating in Russia, he said. Currently, we do not plan any restrictive measures or closures, for example, to close McDonald's, as our citizens work in these companies. Meanwhile, as Russia is contemplating abandoning the dollar, the recently introduced Chinese Petro-Yuan oil futures contract has seen a surge in interest recently, and just last week we showed that the Chinese oil futures contract spiked to a new record high, coinciding with the reimposition of U.S. sanctions on Iran. This was the biggest daily move in China's oil futures since the contract's inception in March to a new all-time high. The move coincided with the first of 2 rounds of U.S. sanctions against Iran kicking off and targeting Iran's access to U.S. banknotes and key industries, including cars and carpets. As we further noted, there has been a notable decoupling from Brent and WTI futures, suggesting a sudden burst of contract-specific buying demand in the petro-yuan. What may explain the sudden surge? Simple. China can effectively bypass Iran sanctions by pricing Iran oil in China's own currency, a move underscored by yesterday's news that China has replaced French energy giant Total with an 80.1% stake in the Phase 11 of the South Pars gas field, which has the world's biggest natural gas reserves ever found in one place. With Russia hinting that it is close to giving up on the dollar entirely in oil trade and shifting to a petro-yuan-based regime, how long before other nations follow suit, especially with the US increasingly energy self-sufficient? The US dollar is surging, and that could soon place an unbearable burden on the oil market, analyst says. Investors are currently seen weighing bullish factors that include potential supply disruptions to Iranian crude exports against more bearish indicators, such as broad greenback strength and a ramp-up in production by OPEC and its allied partners. Typically, crude futures trade inversely to the greenback. A stronger dollar makes oil more expensive to much of the world, so oil prices tend to fall as the dollar rises. It feels like self-harm at the moment in the oil market, Paul Hicken, EMEA oil analyst at S&P Global Platts, told CNBC's Squawk Box Europe on Monday. The prospect of continued strength in the US dollar over the coming months should constitute an even greater concern to bullish oil traders than an escalating trade war between the world's 2 largest economies, an analyst told CNBC on Monday. Investors are currently seen weighing bullish factors that include potential supply disruptions to Iranian crude exports against more bearish indicators, such as broad greenback strength and a ramp-up in production by OPEC and its allied partners. There are lots of variables in the oil market, the most important of which is Iran. If 1 million barrels per day or more of Iranian exports go AWOL, the current fragile supply-demand balance will be upended, potentially sending oil prices above the May peak, Thomas Varga, senior analyst at PVM Oil Associates, said in a research note published Monday. The most obvious thing that could change this bullish view is not the U.S.-China trade war, but the strong dollar that, if it lasts, will put an almost unbearable burden on consuming countries, he added. Risk to the demand picture. International benchmark Brent crude traded at around $72.80 on Friday morning, little changed from the previous session, while U.S. West Texas Intermediate, WTI, stood at $67.43, down around 0.3%. Meanwhile, the US dollar climbed to a 13-month high against a basket of 6 major currencies on Monday, amid renewed financial turmoil in Turkey. The greenback edged around 0.1% higher during early afternoon deals, trading at 96.460 against major peers. Typically, crude futures trade inversely to the greenback. A stronger dollar makes oil more expensive to much of the world, so oil prices tend to fall as the dollar rises. To be sure, recent strength in the US currency has fueled a cautious mood in oil markets. Yet, bullish sentiment found some support from expectations that looming US sanctions against Iran could significantly hamper its crude exports. It feels like self-harm at the moment in the oil market, Paul Hicken, EMEA oil analyst at S&P Global Platts, told CNBC's Squawk Box Europe on Monday. With these risks from sanctions, from the escalating trade war with China, and even from smaller local things like with Turkey, it all feeds into a risk to the demand picture further out, he added. Iran sanctions. The US started reinstating sanctions against Tehran last week, with a second set of potentially more damaging measures due to follow in early November. Iran is OPEC's third-largest oil producer behind Saudi Arabia and Iraq, and currently pumps around 3.65 million barrels per day, according to Reuters data. The last time Iran was sanctioned, about half its current oil exports of some 2.4 million barrels were removed from the market. However, this time around, many energy analysts believe sanctions will remove far less, maybe around half the prior amount. On Friday, the International Energy Agency, IEA, warned the energy market outlook could become far less calm as US imposed oil sanctions against Iran take effect.